Another British high street retailer warns last month's government budget will cost it millions. Welcome to Market Insight, I'm Ramzan Karmali. Well, today Kingfisher, the owner of B&Q, says the increase in UK's employers' national insurance contributions will cost it about £31 million next year, while in France proposed changes to social taxes and the postponement of the abolition of a sales-based tax would cost it about £14 million. Last week, dozens of UK retailers, including Tesco and Sainsbury's, warned the budget will make both higher prices and job losses a certainty and dent investment. But the boss of Greggs shrugged off the UK budget, saying customers will only pay pennies more for their baked goods. So who's right? Well, to help answer that and more, I'm joined by Ed Legget, UK Fund Manager from Artemis. Ed, thanks so much for joining us. So Kingfisher not too happy with either the UK and the French budgets. In terms of the UK, do you think some of these big retailers are right to warn of their impact, or is this something that can be easily absorbed?
I think they're correct. You know, it's a big line for their cost base, the employment costs, and the reality is, you know, they are going up significantly, particularly for those who employ, you know, their workforce close to the living wage, which the majority of retailers will do, and particularly those companies that have a lot of part-time employees. So, you know, we will see the cost going up somewhere between 8 and 10% per each individual you're employing. And when you think about that in the context of their own businesses, they're not going to be able to offset that through productivity gains. So the reality is, we believe, you know, companies will be pushing through price rises that will be inflationary, but the extent of the price rise you need will depend on your own business and how much labour is a percentage of your total cost base. So in reality, for some, it may well be pennies, but if you think about, you know, the average selling price of a Greggs coffee or something, then it is quite low and it is pennies. For others, it will clearly be a higher number, but probably a similar percentage.
Well, let's look at Kingfisher's results a bit more closely. And there was a fall in Q3 underlying sales, and its share price is down heavily today. I think it's the biggest fall on the FTSE 100. Are investors right to be concerned about the future here?
I think Kingfisher's actually been quite a strong performer this year. So it's had this structural issue about, you know, the downturn in DIY and overcapacity in the DIY sector in particular. And over the course of this year, you know, the business has performed reasonably resiliently, and there had been a hope that you would see, you know, a further improvement in sales next year as interest rates fall and consumers, not just in the UK, but also in France and Poland, where their other businesses are, would spend more on DIY and spend more on their houses. Clearly, you know, certainly in the context of the uncertainty around the French political environment, the uncertainty around the budget, in the short term, you've seen consumers actually pull back from spending. And you can see that across the high street. Lots of businesses have called that out. And then when you look into next year, investors are just less confident that we'll see a, you know, big pickup in the housing market because, you know, the interest rate environment has changed in the last 3 or 4 weeks post the budget, post the US election. You know, we've seen bond yields move up, and mortgage rates will be higher than they would have been had that not happened.
Now, there's also a lot of noise around ITV. It's Britain's biggest terrestrial commercial broadcaster, and its weak share price seems to be attracting buyers. What's your take on what's happening there? So
ITV is another company that, you know, they had a trading statement a week or 10 days ago, which highlighted again trading had been weaker because advertisers were pausing ahead of the budget. And when you look at ITV, again, it sort of fits a bit into the same camp with Kingfisher. Investors sort of question structurally, where is this business long term? You know, broadcast TV, is that a growth industry, a declining industry? Where does ITV fit into that? But I think the thing that probably the stock market misses is actually ITV has a significant content business through their studios business. And it's that, I think, which would be attracting attention in the world of, you know, Amazon Prime, Netflix, Apple TV. You know, there's a huge desire for content and people who can create content and shows that can sell around the world. And ITV actually has a lot of those. You know, they have close to $1 billion of turnover coming from just the US alone in terms of selling their content into the US. So I think that will be the bit that's attracted the interest of suitors, and maybe ITV looking at their share price, looking at how the business is valued and going, actually, we've got an opportunity to sort of crystallize some of the parts by maybe selling a stake in that studios business to highlight the value.
So you think that the studio arm and the way it's performing means that the business could eventually be split up?
It's hard, I think, to totally split it up because ultimately, you know, the broadcast business needs content itself, and creating your own content is a way of sort of vertically integrating and taking a larger share of that value. But I think in terms of trying to highlight the value of that studio's business to investors, I think selling a stake in it or would aid that. I think the interest in itself will cause investors to look at the company again.
Ed Legget, interesting stuff. Many thanks for your thoughts. Ed Legget there from Artemis. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.